Welcome to the deep dive. Imagine a company so dominant in its field, it's literally changing how surgery gets done worldwide. Cutting-edge tech meets human health. What if that company built a business so strong, so, embedded, that it was almost impossible to compete with? Well, today, we're diving deep into Intuitive Surgical Inc. That's ISRG. They're the company behind the Da Vinci robotic surgical systems, which I think most people have heard of.
Oh, yeah, definitely. Iconic name.
Right. And our insights today, they're coming mainly from an ISRG investment quality analysis. So it gives us this really comprehensive look at, the business itself, competition, financials, the future outlook, the whole picture.
It's a solid source, gives us a lot to work with.
So our mission today is to unpack what makes this company such a fortress, as the analysis calls it. We want to really understand their business model, which is fascinating, and explore this tension, right, between its undeniable quality and a valuation that just looks, really demanding at first glance.
Yeah, that's the million-dollar question, isn't it? Or maybe multi-billion-dollar.
Exactly. We'll look at the tailwinds pushing it forward, but also the big risks it faces.
Yeah.
So let's get into it.
Great. Where should we start? The business model itself.
Yeah, let's do that. The analysis compares it to the classic razor and blade strategy. Can you break that down for us?
Sure. It's actually a brilliantly simple in concept, but super effective here. So the razor is the big initial purchase, the Da Vinci surgical system. And these aren't cheap. For a hospital, it's a major capital investment. We're talking somewhere between, say, $1.2 million and $2.5 million per machine.
Okay, so that's the big upfront cost.
Yes.
It's a significant hurdle for any hospital.
Right.
So where do the blades come in? How does that make the model so, sticky and predictable?
Well, that's where the magic happens, economically speaking. Once that system, that razor is installed, that's when the long-term, predictable, and importantly, high-margin recurring revenue streams start kicking in. These are the blades. And the biggest source, instruments and accessories. Think about this. For every single surgery done with the Da Vinci, the hospital has to buy these specialized, often single-use instruments.
Consumables.
Exactly. And they cost maybe $1,500 to $3,000 per surgery. Now get this. That segment alone brought in over $5 billion in a recent year out of about $8.3 billion total revenue.
Wow. $5 billion just from the little instruments and accessories used during surgery.
Yep. That's the economic engine right there. It dwarfs the initial system sales over time.
That's incredible. So it's not really about selling the big machine. It's about the continuous use.
Precisely. And there's another layer. Hospitals also sign annual service contracts for maintenance on these complex machines. Those typically run between, say, $100,000 and $250,000 per system per year.
Okay, another recurring stream.
And that line added another $1.3 billion in revenue.
So you add the instruments and the service contracts together.
And you get these recurring sources making up now somewhere between 76% and 83% of the company's total revenue. And that percentage has been steadily climbing up from around 70% back in 2015.
That gives them incredible stability and visibility, I'd imagine,
Yes.
like an annuity.
Exactly. It's remarkably predictable.
So what's keeping this engine running so strong? Why is this model so durable? It feels like there has to be strong demand underneath it all.
Oh, absolutely. It's anchored in some really powerful long-term trends in healthcare. First, there's just this unstoppable shift towards minimally invasive surgery, or MIS.
Right. Smaller incisions, faster recovery.
Exactly. Patients demand it. Less pain, less blood loss, lower infection risk, quicker return to normal life. Who wouldn't want that?
Makes sense.
And surgeons prefer it too, especially with the Da Vinci. It gives them capabilities they just don't have otherwise. We're talking enhanced 3D high-def vision, magnified up to 10 times.
Yeah.
And these wristed instruments, they have 7 degrees of motion. It's like having tiny, incredibly dexterous hands inside the patient, way beyond what a human wrist can do.
That's a compelling advantage for the surgeon. Better tools, better vision.
Definitely. And then you have the broader market dynamics pushing this forward.
Like demographics.
Yeah, demographics are huge. The global population is aging, and there's a rising prevalence of chronic diseases, especially cancers, which often need surgery. The whole robotic surgery market is projected to grow like crazy, something like a 16.5% compound annual growth rate.
16% a year. That's huge.
Yeah, going from around, $11.8 billion in 2024 to potentially near $55 billion by 2034.
Okay, so massive market growth. And what about the cost? Does the high price tag ever become a barrier?
It's always a consideration. The upfront cost is high. But there's growing evidence that the total cost of care can actually be lower. Fewer complications, shorter hospital stays. That saves money in the long run.
Ah, so it aligns with that whole value-based care trend we hear about.
Exactly. It fits right into where healthcare economics are heading.
So this sticky business model, the strong demand drivers, it really does sound like they've built something defensible. Which brings us to this concept of the economic moat, right? The analysis calls it an unbreachable fortress. What makes it so strong?
It really is a fortress, and it's built on two main pillars. Incredibly high switching costs and really powerful intangible assets. And they kind of feed off each other.
Okay, high switching costs. We mentioned the initial price tag, but you're saying it's more than just the money.
Oh, much more. The money's just the start. The real lock-in comes from the investment in human capital and the way hospitals organize workflows around these systems.
Human capital, meaning the surgeons and staff.
Precisely. Think about it. There are over 76,000 surgeons worldwide who have spent hundreds of hours learning and mastering the Da Vinci platform. They've developed specific muscle memory, technical skills. Their professional reputations are often tied to their proficiency with this system.
So asking them to switch to a competitor's system
means asking them to go through a really tough, time-consuming relearning process. It's a huge ask. Professionally risky, even.
Right. And it's not just the surgeons, is it?
No, it ripples through the whole institution. Nurses, technicians, administrators, they're all trained on Da Vinci protocols. Hospitals often build entire robotics programs as flagships, marketed around the Da Vinci.
Yeah.
Changing systems means disrupting all of that deeply embedded workflow. It's a massive operational headache.
Okay, that makes a lot of sense. The switching costs are deeply rooted in people and process. What about the intangible assets?
Well, first, there's the brand. Da Vinci is practically synonymous with robotic surgery after 2 decades. That builds enormous trust, which is critical in healthcare.
Sure.
Then there's the patent portfolio, over 1,700 active patents protecting their tech.
Okay.
But the biggest intangible, and maybe the most underappreciated, it's their data.
You mentioned the 14 million procedures earlier.
Exactly. That's not just a number. It's the world's largest, most detailed data set on robotic surgery outcomes, techniques, everything. And it's not just sitting there, it's a living asset.
We mean living asset.
They're actively using it to refine surgical algorithms, improve surgeon training with incredibly realistic simulations, and develop AI-powered clinical insights. The latest system, the Da Vinci 5, has something like 10,000 times the computing power of the previous one.
10,000 times.
Yeah, specifically designed to crunch that data, to leverage it. It transforms the moat from just like passive defense walls into this active learning network.
That sounds incredibly powerful. Can we maybe walk through an example like that Delray Medical Center case mentioned in the analysis?
Yeah.
How does this all play out in reality?
Sure, it's a great illustration. So a hospital like Delray decides, okay, we're investing in the latest Da Vinci 5. First, there's the big check, right? Over $2 million.
Yeah.
Then their top surgeons spend months in intensive Da Vinci-specific training. Their skills, their careers become linked to this platform.
Okay, the human capital investment.
Right. Then the hospital launches a big marketing campaign. Come to Delray for state-of-the-art robotic surgery. Their reputation gets tied to the Da Vinci brand.
Building that program identity.
Exactly. Plus, they sign the multi-year service contract and start that continuous buying of instruments for every procedure.
Locked in.
Pretty much. Now, imagine a competitor, say Medtronic or J&J, shows up with a potentially cheaper robot. The hospital has to weigh switching against writing off that $2 lovely plus investment, retraining everyone, disrupting workflows they just perfected, and potentially damaging the reputation of their flagship program.
The path of least resistance is just stay with Intuitive.
Overwhelmingly, yes. The incentives are stacked against switching.
So the moat isn't just strong. It sounds like it's actually getting wider, deeper, even with new players trying to enter the market.
That's absolutely the case. Despite new competition, Intuitive market share is still dominant, projected around 70% even out to 2030. And their installed base keeps growing fast, like 15% growth in late 2024, pushing them towards 10,000 systems globally.
And each new system adds more data.
Which strengthens the network effect, improves the AI, enhances the training. It's a virtuous cycle that's incredibly hard for anyone starting now to replicate. And they're leaning into it too, acquiring companies like Orpheus Medical specifically to boost their data and informatics capabilities. They know data is key.
Okay, that paints a clear picture of the business and its defenses. let's shift perspective a bit. What are we hearing from, the boots on the ground?
Yeah.
The hospitals using these things, the employees working there. What's the scuttlebutt?
Well, simulating that kind of on-the-ground research, the feedback from customers, hospitals, and surgeons is generally very positive. You hear terms like medical marvel. They see real patient benefits, faster recovery, fewer complications. That core value of precision, control, vision, it gets validated again and again.
And there was that stat. A 92% repeat purchase rate.
Yeah, staggering, isn't it? It's a huge signal of customer satisfaction and loyalty.
Now, is that purely satisfaction, or does that high switching cost we just dissected play a big role in that number? Are they satisfied or just kind of locked in?
That's a fair question. It's almost certainly a mix of both. The technology clearly delivers value they appreciate, but yes, the switching costs absolutely reinforce that loyalty. The two work together, really.
Makes sense. And what about the employees? What's the vibe inside the company?
Overwhelmingly positive, actually. Intuitive regularly shows up on best places to work lists. They get high ratings on Glassdoor, like 4.4, 4.5 out of 5. People talk a lot about the mission-driven culture.
Meaning
They feel connected to the idea of helping patients. They also praise having really smart colleagues and getting paid competitively. And the CEO, Gary Guthart, seems exceptionally well regarded. Gets an A+ rating on Comparably.
Sounds pretty good, but no company's perfect.
Mm-hmm.
Are there any recurring complaints or friction points, any blemishes that pop up?
Yes, there are consistent themes. People often mention a really fast-paced environment with high-performance expectations. Seems intense.
Okay. Where does that pressure seem highest?
It seems particularly acute in customer-facing roles. There's a junior position called Territory Associate, and reviews often mention demanding schedules, really steep learning curves, and poor work-life balance. Burnout seems like a real risk there.
That's interesting. So while the core engineering and leadership seem strong, there might be stress at the front lines.
Potentially, yeah. And that's something to watch because service and support quality are absolutely crucial for keeping that whole ecosystem running smoothly. It's a potential vulnerability if burnout affects customer interactions.
Good point. Okay, let's talk about the leadership itself and the company's financial footing. Management stewardship seems like a real strength here.
Absolutely. It stands out. You've got remarkable stability at the top with Dr. Gary Guthart. He's been CEO since 2010. And even though he's transitioning to executive chair soon, in July 2025, it ensures his strategic mind stays involved. That's huge continuity.
And his operating philosophy. How does that actually guide the company? You hear CEOs talk, but how does it translate?
Well, Guthart really embodies this long-term owner-like thinking. He's very clear about the stakeholder hierarchy. It's patients first, then physicians, then hospitals, then employees. Shareholders are actually last on his list.
That sounds counterintuitive for a public company CEO.
Right. But his logic is that if they create exceptional value for those first 4 groups, then exceptional and durable returns for shareholders are the logical and inevitable outcome.
Interesting philosophy. Does he have like a guiding principle?
Yeah, he talks about the quintuple aim, which is better outcomes, better patient experience, better care team experience, lower total cost to treat, and improves access to care.
Okay, pretty comprehensive.
And these aren't just slogans. They seem to genuinely drive R&D priorities, training programs, everything. He's also known for being candid, unwavering belief in the long term, but honest about near-term bumps.
That kind of leadership must influence how they spend money, their capital allocation.
Definitely. It's very disciplined, very rational, and laser-focused on reinforcing that economic moat we talked about. Job number 1 is aggressive reinvestment back into the business. R&D spending has just exploded from maybe $116 million in 2010 to over $1.14 billion in 2024.
Wow.
And capital expenditures, building factories and training centers globally, they're spending $800 million to $1 billion a year on that.
Pouring money back in.
Yeah.
What about acquisitions? Are they buying up competitors?
No, they're actually pretty infrequent buyers, and when they do buy, it's very strategic, aimed at strengthening the moat. Like in 2019, they bought part of their endoscope supplier, Schully Fiber Optic, just to secure their supply chain. Or in 2020, buying Orpheus Medical to specifically enhance that data moat capability. Very targeted.
Okay. And shareholder returns.
Yeah.
With all the cash flowing from those recurring revenues, do they pay a dividend?
They don't, actually, which makes sense, right? If you have such great opportunities to reinvest internally at high rates of return, paying a dividend might not be the best use of capital.
True. So what do they do with excess cash?
Opportunistic share buybacks. They had a $4 billion program authorized recently, bought back over 11 million shares in 2022, for instance. It signals that management thinks like owners reinvest first, then buy back stock if it seems undervalued, rather than just sending cash out the door.
Okay, so smart capital allocation. Now, the overall financial picture, the analysis calls it a fortress. Is it really that strong?
Yeah, fortress is a good word for it. Financially, they are exceptionally strong and resilient. It's just a reliable earnings machine. Consistent revenue growth, consistent net income growth, barring that temporary blip during COVID. And their gross margins are fantastic, consistently in the high 60% range, like 67.5% in 2024. Very profitable core operations.
What about some key ratios, like return on invested capital, ROIC? The analysis mentions it's around 13-14%. For such a dominant company, does that seem a bit low? Or is there a story there?
That's a really sharp observation. And yeah, 13-14% is solid, but maybe not spectacular on the surface. But the analysis points out it's temporarily suppressed. Why? Because of those massive upfront investments they're making right now.
The new Da Vinci 5, the global expansion.
Exactly. They're pouring billions into future growth platforms and infrastructure before those investments fully pay off. So the IRO in ROIC, the invested capital, is huge right now relative to the current returns. The expectation is, as those investments mature, the ROIC will expand significantly.
Okay, that makes sense. It's artificially low due to heavy investment. What about free cash flow? The conversion rate looked a bit variable too.
Similar story there. Free cash flow conversion was around 56% in 2024. Again, that's because those huge capital expenditures over $1.1 billion are eating into it. The key thing is the operating cash flow, the cash generated from the actual business operations, is incredibly strong. $2.4 billion in 2024. They're just choosing to reinvest a huge chunk of that back into the business for future growth, rather than letting it pile up as free cash flow right now.
So strong underlying cash generation, just being redeployed aggressively. That signals a lot of confidence in future returns, doesn't it?
Immense confidence. And it's backed by a balance sheet that's just pristine. An impregnable fortress is how the analysis puts it. Meaning, as of early 2025, they had over $9.1 billion in cash and investments on hand.
$9 billion in cash.
Yep. And virtually zero long-term debt. Their net debt to EBITDA ratio is way negative. It gives them this enormous safety margin. They can weather almost any storm, make opportunistic acquisitions, fund R&D, all without needing outside money. Huge strategic flexibility.
Okay, now we get to the crux of it, right? The price to value question. We've established this incredible quality, the moat, the financials, fortress-like. But then you look at the stock price, the valuation, PE near 80x. Price to free cash flow over 100x. That looks crazy expensive. How can anyone argue that's fair, let alone attractive for someone buying today?
This is where the tension lies, isn't it? Absolutely. You've nailed the core dilemma. As of mid-2025, the valuation is undeniably demanding. No question. Trailing PE ratio in that 77x to 82x range. Price to free cash flow, like you said, 111x to 115x, and that's inflated by the heavy capex cycle.
And how does that compare historically?
Well, it's significantly above its 10-year average PE, which was closer to 59x, and moderately above the 5-year average of maybe 71x to 74x. So yeah, the market is definitely pricing in a lot of future growth and continued success. High optimism baked in.
So definitely not a bargain by any traditional measure.
Not even close. If you're looking for cheap, this isn't it. However, for an investor thinking in terms of decades, not just quarters or years, the argument is that this valuation could be seen as fair, maybe even bordering on attractive, precisely because of the unique compounding quality of the business.
Okay, explain that leap. How does expensive become fair?
It hinges on believing the market might still be underestimating the durability and the compounding power of that widening economic moat, especially that data and AI network effect we talked about.
So the idea is you're paying a premium, but it's for truly exceptional, long-lasting growth that others can't easily replicate.
That's the essence of the argument. It's a bet that the quality and the runway are so extraordinary that today's high price will look reasonable in hindsight decades from now. You rarely get companies this good at cheap prices.
Okay, so what does that long, invisible growth runway actually look like? Where's the future growth coming from to justify that premium?
Well, the main driver is just more surgeries being done robotically. More procedures equals more instrument sales, more service revenue.
Right, the core engine.
And that comes from a few places. First, just going deeper into existing surgery types. Like general surgery, it's still only about 22% penetrated by robotics as of 2023. But U.S. general surgery procedures grew 19% for Intuitive in 2024. Huge room to grow even in established areas.
So more adoption in common surgeries. What else?
Geographic expansion. Markets outside the U.S. are growing even faster procedure volume, up 23% in 2024. They're investing heavily in Europe, Asia, lots of untapped potential globally.
Makes sense.
And third, new technology platforms opening up totally new areas, like their Ion system for lung biopsy that saw crazy growth, like 70% in Q4 2024. Or the Da Vinci SP single port system for surgeries through one small incision. These expand the total number of procedures they can address.
So deeper penetration, wider geography, new applications.
Exactly. It all adds up. The overall procedure growth forecast for 2025 is still really healthy, somewhere in the 13% to 16% range. That fuels the whole model.
Okay, we've laid out a really compelling bull case based on quality, moat, and growth. But let's be critical. What are the real significant long-term threats? What could genuinely derail this fortress? What's the bear case?
It's crucial to think about that because no moat is truly permanent forever. The biggest kind of existential threat isn't really from current competitors trying to make a similar robot. It's more likely a black swan event, a completely different technology emerging.
Like what?
Imagine, say, advanced biologics or some kind of targeted energy therapy that just makes complex invasive surgery unnecessary for conditions currently treated by Da Vinci.
So, something that shrinks the entire market for this kind of surgery.
Exactly. It wouldn't matter if Da Vinci is the best robot if the need for the robot itself diminishes significantly. Technological obsolescence is always the ultimate long-term risk for a tech leader.
That's a sobering thought. What about more immediate, maybe systemic pressures?
Well, the high cost of the whole Da Vinci ecosystem is a constant friction point. Hospitals and insurers are always looking at costs. So a major negative shift in reimbursement policies, say, Medicare decides to pay less for robotic procedures, or even just a deep, prolonged recession, forcing hospitals to clamp down on spending. That could really hurt their growth rate and squeeze those nice margins. They're always walking that tightrope between demonstrating value and just defying the price.
Right. And being so dominant with this sort of closed ecosystem, does that attract regulatory attention? Antitrust risk?
Oh, absolutely. That's a big one. When you have 70% plus market share and your model relies on selling proprietary instruments and services tied to your machine, regulators in the US or Europe are bound to scrutinize that. Could they force Intuitive to open up the system? Mandate interoperability? Challenge the tying arrangements?
And that would hit the recurring revenue model hard.
Devastatingly hard. That's where the real profit is. They've already faced class action lawsuits about anti-competitive practices, so regulatory risk is a constant shadow.
Okay, let's try to pull back and apply some second-level thinking, as the analysis calls it. The market consensus seems pretty clear. Great company, best-in-class tech, strong moat. But the stock's expensive. Growth is good, but maybe not that good to justify the price, especially with competition looming. That's the basic story, right?
Yeah, that sums up the general Wall Street view pretty well. High quality, but priced for perfection, maybe even beyond.
So what's the deeper view? What might that consensus be missing?
The deeper analysis suggests the market might still be thinking of Intuitive primarily as a medical device company or a hardware company, making sophisticated robots. But what if it's rapidly evolving into something more like an AI-enabled healthcare platform?
Okay, so shifting the frame from hardware to platform and data.
Exactly. That 14+ million procedure data set. It's not just a historical fact. It's the foundation of that AI moat we discussed.
The data feeds the AI. Yeah. The AI improves the system and outcomes.
Which leads to more procedures, which generates more data. It's a powerful network effect. That data is being used right now to train AI that could eventually offer real-time guidance in surgery, a digital co-pilot.
Wow.
This creates an advantage that gets stronger with every single operation performed globally. It's potentially unbreachable, and it might open up totally new high-margin digital revenue streams down the line, things related to insights, analytics, AI features that maybe aren't fully factored into today's price.
So the market sees the fortress walls, but the deeper view sees this intelligent learning network being built inside those walls.
That's a great way to put it. The market might be underestimating the compounding power of that intelligence layer.
That's a fascinating counterpoint. But let's push back again. Let's do the red team challenge. Invert the bull case. What's the strongest argument for why buying Intuitive today, even with everything we've said, could turn out to be a huge mistake? What if the bull case is just wrong?
Okay, the core question for the red team is, What if we're paying this premium price right at the peak of Intuitive's dominance, just as its advantages start to slowly, maybe imperceptibly at first, erode?
Peak dominance. Okay, how would that happen?
Well, first, maybe we underestimate the competition. Medtronic, J&J, they're huge companies with deep pockets and vast hospital relationships. Maybe they don't need a better robot. Maybe they just need one that's good enough and significantly cheaper.
Good enough and cheaper.
And crucially, they can bundle their robot with all the other stuff hospitals already buy from them: sutures, staples, energy devices, you name it. They can offer package deals that a pure-play robotics company like Intuitive just can't match economically.
That's a powerful point, the bundling advantage.
It really is. And what if that combines with extreme financial pressure on hospitals? What if they reach a breaking point and just revolt against Intuitive's high-priced closed system of proprietary consumables?
A healthcare system revolt.
Yeah. Maybe that pressure forces them to adopt the good enough, cheaper competitor systems in droves, or maybe it finally triggers that regulatory intervention we talked about, forcing interoperability or price controls. Either way, the result is the same. The high-margin recurring revenue model gets permanently damaged.
And if that happens?
Then buying the stock today at nearly 80 times earnings means you bought right before growth slows and margins compress. That's the nightmare scenario.
A classic growth trap.
Exactly. You overpaid for a wonderful company whose best days in terms of market dominance and profitability were actually just behind it. That leads to years of flat returns, or worse, significant losses. It's the risk of mistaking the end of a chapter for the beginning of a new one.
Wow. Okay, so we've really explored this fascinating dual nature of Intuitive Surgical, haven't we? On one hand, you have this incredible business, this amazing competitive moat, rock-solid financials.
Mm-hmm. Truly exceptional quality.
But on the other hand, it trades at this really premium valuation, and it faces these undeniable long-term risks from technological disruption to regulatory pressures.
Yeah, the tension is palpable.
We've seen how its success so far is really tied to that brilliant razor blade model.
Right, the foundation.
But its future strength, that enduring value, might really depend on successfully evolving into this AI-enabled healthcare platform. That data moat seems key.
It really does feel like the next frontier for them.
So as we wrap up, maybe the provocative thought for you, the listener, is this. What does it mean when a company's quality today is so clear, so defined by its current dominance, but its truly lasting value might hinge on something less tangible, more emerging, like this data moat?
Yeah, how do you weigh that? How do you balance the very real economic pressures, the competitive threats we just discussed, against the potential, maybe revolutionary potential, of a future where surgery is deeply integrated with AI, all driven by this one company's unique data advantage? It's a fascinating puzzle.